From the morning reading, the Qs are at resistance, poised for breakout to join the Diamonds, IWM, and Spider at new highs. Breadth strengthened as decliners led 1551 to 1465 on the New York Stock Exchange and led 1405 to 1341 on the NASDAQ. On the S&P 500 snapshot, a fractional gain on strong economic data. The big pre-open economic news was an upward adjustment to Q3 GDP to 3.2%, exceeding consensus forecast of 3.0%. The S&P 500 stuttered at the open, no doubt perplexed by the apparent strengthened odds of a December rate hike. The index then rallied to its 0.40% intraday high about 90 minutes before the close, at which point some profit-taking trimmed the gain to a fractional 0.13%. The yield on the 10-year note closed at 2.30%, down 2 basis points from the previous close and 6 basis points off its interim closing high set at the end of last week. The earnings recession is over. A likely boon to sentiment in recent weeks has been the increasing likelihood that the S&P 500 companies would show earnings growth in the most recent quarter for the first time in nearly 2 years. But the end of the lengthy earnings recessions did not consistently lead to gains going forward, highlighting the fact that there isn't a strong correlation between growth in earnings and future returns in stocks. Traders are avoiding bets against the VIX. Inverse volatility funds that profit when the VIX falls have seen their assets decline by an average of 10% over the recent 5-day period, the largest exodus in years. These haven't been smart money traders and are now covering their bets in case the VIX rises. Their last big bet, that volatility would collapse in early November, was spot on. Option traders keep betting against bonds. The put-call ratio on the 10-year Treasury note futures has averaged nearly 1.9 over the past 20 days, the highest since September of 2014, and ranking in the top 5% of all readings since 2000. Put-call ratios on bonds are not as consistent as they are for stocks, but there has been a strong contrary tint to them, which would be a minor positive for bond prices here. Seasonality isn't a given. The positive bias in November-December gets a lot of attention, but it's not a certainty. In the history of the main S&P fund, SPY, it showed a positive return on the second to last day of November through the first 2 weeks of December, only 13 out of 23 years, and its overall average return was a negative 0.2%. The past 4 years have all been negative, and the last 2 years were losses of more than 3%. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:01 a.m. Mountain Time, and I recorded this in preparation for the market day of November the 30th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. At the time of this cut, all 4 of the U.S. broad-based indices were positive. The S&P futures were up about 0.25%. Russell and NASDAQ futures were up just above scratch, and Dow futures were up just under 0.25%. Crude oil up huge, some 6.8%. Obviously, ramifications from OPEC coming in the overnight. Euro down just below scratch. Bonds down about 0.5%, and gold down about 0.5%. China down about 1%. The other foreign markets that we watch are all positive. Hong Kong up about 0.25%, Japan right about scratch, Germany up about 0.33%, United Kingdom up about 1%. And macroeconomic reports for today in the United States of note, we have non-farm employment change, core price index, personal spending, Chicago PMI, pending home sales, the weekly crude oil inventories, FOMC member Powell speaking, and that looks to be about it. We had so many reports, didn't have any room for tomorrow, so we're just got today's this time. In terms of current volatility, short-term VIX obviously is up in the last couple of days compared to prior sessions, about 12.64. Skew continues to be just above the first caution threshold, coming in at a 128. IV percentiles also still very, very low, though perhaps a bit up off the recent lowest percentiles we've seen. The S&P at a 20, the Russell 25, the NASDAQ at a 14, and the Dow at a 19. No standard deviation size moves were put in on any of the 4 U.S. broad-based indices yesterday on a close-to-close basis. In terms of current charts, here we've got the S&P futures, and you see the action. Last week we had the new swing high and a little bit of consolidation since then, and perhaps setting something up of a bull flag. The expectation, given the indicators at this point, is that we're not going to look for a huge retracement. Even though this move was really, really large, the indicators are not calling for a significant retracement. And we may indeed only get 1, 2, 3 days of retracement consolidation before we get another leg up. Now, at the same time that the indicators aren't calling for a large retracement, they're also probably, given the amount of prior move and the small retracement, probably would not have a next long leg up being significant either. So we're probably in a situation where we make small incremental new highs over time, and this strong bull market kind of continues to just kind of chew its way up. Is the best probability of what the indicators are saying right now. Obviously, at any time, new information can come in the market and it can go in any direction. You see the Dow futures are actually made an overnight new all-time high, and so that bull flag has fired during the overnight session. Now we'll see what the cash market participants do, but certainly that is a hopeful news so far. NASDAQ, of course, has been pounding its head up against this area of resistance. Yesterday, at one point, coming within, some 20 points of its all-time high, and that was on an inter-day basis. So getting very, very close, but still have not yet broken. If the S&P and the Dow and so forth start to break out of their bull flag patterns, we could very well see the NASDAQ come up here and seriously test that area of resistance. Now, why is Amazon and the others doing poorly of late? You know, there's obviously a lot of implications for these companies in terms of global trade. If some of these markets start to, have tariffs or something like that, some of these could have their own implications. And a lot of business for Apple comes from China now, and you see it's stuck in kind of a neutral zone. So very, very difficult for the NASDAQ futures to be powering the new time highs when you got these FANG stocks that are doing relatively poorly. And we got several that are below the cloud here. And then you also have some that are at best neutral. And I guess Apple actually being the one that's strongest of this group of 4 that we just looked at. But these are very large capitalized companies. And without their participation in full out breakouts to the upside, it's very difficult for that NASDAQ to make those new highs. So that's kind of what's going on underneath the hood as to why the NASDAQ is struggling a bit. Now, one that, of course, has not been struggling has been the Russell, and has, not only overshot the bottom side of the channel and then 15 straight sessions to a new all-time high and overshoot at the top of the channel, had a little bit of a retracement, which thus far has only come back to the former resistance, now turned support. We'll see if that continues to hold true. I kind of suspect that it'll probably fall back within the channel, but then hug the upper line. this is just such a remarkable move, but we'll see what it actually does. Certainly the small caps are on fire, and even though we've had a bit of a retracement at the beginning of this week, this has been a very, very small nominal retracement given the scale of the prior move. Let's take a look at some of the other markets. We've heard, of course, that in crude oil had a huge move, and this one's been subject to a lot of news coming out of OPEC, but you see this move here, huge candle, but look at where it stopped in the overnight, right there within a couple pennies of the prior swing high. So we'll see if this gets through and is able to power back up here towards the prior highs. And I'm going to go ahead and remove this drawing here that was referring to a retracement back here. We now have this higher swing high, but the essence of it is that we're still right smack in the middle of this channel between this swing high and especially these lows. And we're in the middle of the cloud right now, so a lot of volatility, but ultimately not really having achieved anything in terms of trending action as of yet. So we'll see if crude oil starts to set up. Now, we actually want to see, in some ways, crude oil prices come up, because that tells you that there is a growing global economy that is in need of more fuel to drive that economy. And so the fact that we had some weakness in here, obviously there's a lot of plays to this. There's the oversupply and all these other pieces, but you know, we want to see demand is the bottom line. We need to see demand. It's not just about supply all the time. It's also about global demand. Now, gold, of course, gold continues to have some weakness, and it's been very much in a primary bearish trend at this point, having broken the prior intermediate term bull trend back here in October. And then the expectation is that we'll continue to see these lower highs and lower lows, but we're right now in a multiple day consolidation pattern. Ultimately, we expect this to break down to the downside. Now, a big part of whether it does that or not, of course, will be what the dollar does. The dollar is set up in a bull flag pattern, which is not yet broken out to the upside. If that dollar does break out to the upside, we could very well see an impact on gold and crude oil and other commodities, etc. And let's take a look at bonds. Bonds also in a very, very weak pattern, in a sideways consolidation pattern. Expectation is that it will continue to break down, and you had an intraday low, new low for the 52-week period that was set just last week. And then finally, volatility. Volatility very low, very much in the normal bull market range, in that 12 to 15 area. So nothing particularly fearful being priced into the market right now, and has been coming into the lower 12 handle. If it gets down into the 11 handle, that'll certainly be as low as it's been even this year. Okay, that should be enough on the charts for today. Let's go ahead and go to the daily report. And in terms of the intermediate term phase opinion, the expectation is for phase 3 activity. Bull Flagville is the descriptor. And in that market phase, we do expect to have, until proven otherwise, small consolidations, relatively short consolidations, followed by breakouts to the upside. Now, given the size of the moves, we would measure those breakouts to the upside to be relatively small and incremental, but consistent until, again, proven otherwise. In terms of the market timing signals, there's 3 of them that we follow. The first one comes from IBD and is, like all 3, mechanical in nature. Confirmed uptrend, that's bullish. The second one, GMI index, a perfect 6 out of 6 on the primary signal. Buy signal has been in place since 11:10. The third one, the stock charts decision point scoreboard, no change from yesterday. So we're left with very strong short term, improving intermediate term, and a mixed long term. So a bit less strong of a signal there than we would like to see. Though we have to recognize the consensus of all these three is certainly bullish, but until we get the stack of agreement across the decision point scoreboard, we have to say that it's not, truly a super healthy bull, but it certainly is recognized as being an improving bull. Position sizing opinions on both models are coming in at 100%. Intermediate term market postures across all four index are as strong as they could practically be. These things peg out 100, and you see they're all within, 2, 3, 4 points of being pegged right up against the ceiling of that indicator. So severely strong bull, which is supported by a bullish sentiment line. So again, expectations with that bullish sentiment line are that retracements are generally shorter and milder, and then the bullish legs are longer and more significant. Hedge warning status, level 0+, normal with some elevated conditions, primarily looking for some agreement on the stock chart's decision point. In terms of strategy opinions, no change from yesterday. You have in quotes, permission opinion on all three of these strategies to initiate new positions, though in the cover call strategy still being somewhat defensive with an equal ratio of in the money, out of the money strikes, equal ratio of low beta and high beta positions. Remember, in terms of put selling, that watch those individual chart setups, but these pullbacks could be relatively mild before they leg up for the next one, especially if the FANG stocks, the Facebook, Apple, etc., if those start taking off, the market could start really moving and leaving you behind. So the opportunities to be able to buy on dips or to sell put spreads on dips become challenging in true bull markets. So you have to kind of take your opportunities when they present themselves. Also consider opportunities coming out of earnings. If there's a miss, that's often, frankly, more of an opportunity to put on a position than it is to be fearful. And then the last thing about this is that you can always scale into these positions. That's one of the nice things about using option positions. If you're not convinced that you've got a reversal and that short retracement to the downside isn't over, you can kind of build a position until you have your entire position on. In terms of specific warning areas, you have several, but they're all kind of, for the most part, relatively low grade. We do watch for change and rate of change, and certainly we notice this new amount of red that is in place for the last couple days. Actually, these two did go back after one day of being in the red back to the okay. I just forgot to change the color on them, so those should be black. You did have the ratio warning fire one session prior, and we did obviously see a small incremental amount of uptick in volatility. As to whether it's going to continue to uptick in volatility, we'll have to wait and see. But, thus far, nothing looks particularly concerning. And indeed, the VIX, remember, is in that lower range between the 12 and 15 zone, the area of normal bull markets. The current distribution day count is increasing on NASDAQ, went back up to a 9, but there's a number of days coming up in the next few sessions which this could actually start to reduce. So we'll watch to see how this distribution day count goes. Obviously, we talked with the charts. There's, some real differences going on with the NASDAQ versus the other indices, and this is being reflected in the distribution day count. Skew continues to be relatively low grade warning, just above the minor threshold of 125. And the S&P 10-day out expected move actually dropped back under warning status with yesterday's action. On the trend-based area, everything is strongly bull, nothing there of concern. In the intermarket risk aversion indicators, all 5 indicators are showing early signs of rolling over, but they've not yet rolled over. They're still all risk on, so we'll continue to watch and see how this develops and see if we start to see, this set of warnings start to increase and accelerate. which would measure a larger retracement. But at the same time, that hadn't actually happened yet. And you could have a lot of these where they look like they might be rolling over, but then continue on. So until it actually crosses, we don't call it risk off. And but I would note that all 5 of those did show early signs of rolling over. From a sentiment standpoint, 71. So basically, several sessions now in a row with sentiment at about the same general area. Certainly not extreme yet. Anything over 75 would go to extreme sentiment, and that's where you start to look for signs of potential reversals. Overall, sector strength and breadth yesterday was pretty strong. While the day had an incremental increase of only plus 0.16%, you see most companies were positive for the day, including many that had been in recent sessions largely the ones that we're sector rotation out of. Real estate, healthcare, utilities all had good days. Consumer staples also positive for the day. But you see all these, with the exception of healthcare and real estate, were relatively minor increases for the day. So kind of small action day. In terms on the downside, energy was the big one down, being driven by OPEC-related news, and you've seen that's already been nullified in the overnight section. Crude oil up almost 7% thus far in the overnight session. In terms of sector percent change, we continue to see some weakness in consumer staples, healthcare, and energy. Energy, I suspect, will be reversed with today's action if those markets aren't brought in with new information from OPEC meetings. The bottom line, healthcare, consumer staples are clearly the weaker areas. If you're looking in your watch list for opportunities, these are not the most bullish places to be going right now. And indeed, in terms of consistency of performance, which is the primary thing we look at in terms of this percent change across the 1 day, 5 day, 1 month, 3 month, etc., probably financials are going to be the strongest performer in recent intermediate term price action, and then industrials also doing quite well during that period. Whereas on the flip side, healthcare and consumer staples has been probably the weaker areas and certainly subject to more struggles. Okay, we're up over 20 minutes, so we're going to go ahead and wrap up for today. And I'm scrolling through these. If you need to see more of any of these slides here, just hit the pause button or rewind and hit the pause button, and you can go to those hyperlinks for additional information. In the meantime, disclaimers, as always, hit the pause button if you need more time to read the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. And we'll be back here next for tomorrow's market preview from Falcon Global. In the meantime, manage that risk profile. You'll find that consistency that you've been looking for. And then, of course, each and every single trading session, seek to go out there and learn something about your all-important craft. Good trading.